Have you ever dreamed of living off passive income without having to lift a finger? What if I told you it's possible to achieve this through dividend investing, and you don't need millions of dollars to make it happen? That's right. In today's video, we're going to bust some myths, explore various investment strategies, and show you the most realistic way to reach that passive income dream. So sit back and get ready to discover the secrets behind living off dividends without breaking the bank. Now, before we dive into the world of dividend investing, let's first understand why it's such an appealing form of passive income. Sure, there are other options for earning passive income, like owning rental properties, selling your own book, or starting a blog, but dividend investing stands out for a few key reasons. 1. Minimal effort. Unlike rental properties, where you need to worry about maintenance, finding tenants, and evictions, dividend investing requires little to no effort once you've set up your investment portfolio. Your dividend payments are automatically deposited into your brokerage or bank account every month or quarter, making it the epitome of hands-off passive income. 2. Consistent income stream. With dividend investing, you can rely on a consistent income stream as long as you invest in stable companies or funds. This is in contrast to, say, blog or book sales, where your earnings might be sporadic and fluctuate depending on market trends. 3. Flexibility. Dividend investing allows you to adjust your investment strategy over time as your financial goals and risk tolerance change. You can choose to reinvest your dividends to grow your portfolio, or you can use them to supplement your income, giving you the freedom to switch careers, reduce your working hours, or spend more time with your family and friends. 4. Diversification. By investing in a variety of dividend-paying stocks or funds, you can diversify your income sources, reducing the impact of market fluctuations and minimizing the risk of losing your entire investment. So it's clear that living off dividends has several advantages over other forms of passive income. But you might be wondering, how can you achieve this without investing millions of dollars? Many people believe that living off dividends is only possible for the super rich, and it's not hard to see why. If you do a quick search on the internet or watch videos about living off dividend income, you'll find countless sources stating that you need at least $1 million or even several million dollars invested to make this a reality. And let's face it, for most people, that kind of money can seem impossible to accumulate. For example, according to a Business Insider article, if you want to retire by the age of 35 and earn $65,000 a year from dividends, you need a minimum of $3.3 million saved up in your stock portfolio. Even if you plan to retire later, at age 65, they claim that you would still need $1.6 million saved up to generate a yearly income of $65,000 until you're 90. But what if I told you that living off dividends is possible without investing millions of dollars? Let's set a goal for ourselves, living off $4,000 a month in dividend income. Let's examine 3 different investment approaches that could help us achieve this goal, looking at the pros and cons of each strategy. Dividend growth investments. Dividend growth investments focus on stable, well-established companies that have a history of increasing their dividend payouts over time. One popular example is Johnson & Johnson, a multinational pharmaceutical and consumer goods company. Investing in dividend growth stocks can be a smart long-term strategy, as the rising dividends can eventually compound and generate a sizable income. However, the main downside of this approach is the time it takes to reach a point where you can live off the dividends. Stocks like Johnson & Johnson typically have lower dividend yields, around 2.45%, which means you'll need to accumulate a significant amount of shares before you can generate $4,000 a month in income. This could take decades, making it a less attractive option for those looking to retire early. Higher-yielding investments. If you're looking for higher dividend yields, you might consider investing in real estate investment trusts, REITs, like Realty Income. REITs are required by law to pass on 90% of their earnings to shareholders in the form of dividends, often resulting in higher yields than traditional dividend growth stocks. Realty Income, for example, currently has a yield of 3.95%. Despite the higher yield, it would still take a substantial investment of over $1.2 million to generate $4,000 a month in income from Realty Income. Although this is more attainable than the amount needed for Johnson & Johnson, it still presents a significant barrier for most investors. High dividend yield stocks. Some investors may be drawn to high dividend yield stocks like Altria, an American company that manufactures and sells tobacco and alcohol products. Altria currently offers an impressive dividend yield of 7.27%, which is significantly higher than both Johnson & Johnson and Realty Income. To generate $4,000 a month in dividend income from Altria, you would need to invest around $660,000, a much more achievable sum than with the previous two strategies. However, relying on just one high-dividend stock for your entire income is risky. Diversification is essential in any investment portfolio, and putting all your eggs in one basket could leave you vulnerable to sudden dividend cuts or stock price declines. Let's now explore an alternative investment option that offers high dividend yields, diversification, and the potential for sustainable income: covered call ETFs. First, let's discuss the importance of diversification in your investment portfolio and the risks associated with relying on a single stock to generate the bulk of your passive income. Having a well-diversified portfolio is a fundamental principle of investing and can help protect your investments from market fluctuations and company-specific risks. 1. The importance of diversification. Diversification is the practice of spreading your investments across a variety of assets, such as stocks, bonds, and real estate, to minimize risk. By holding a mix of different investments, you can reduce the overall volatility of your portfolio, since the poor performance of one asset is less likely to significantly impact the value of your entire portfolio. A diverse portfolio can help protect against market fluctuations. Diversification can cushion your portfolio against market volatility. For instance, if the technology sector experiences a downturn, it may not affect your investments in other industries as much, keeping your overall portfolio relatively stable. Reduce company-specific risks. Investing in multiple companies within the same industry can help minimize the impact of one company's poor performance on your overall returns. For example, if you hold shares in several pharmaceutical companies, a negative announcement about one of them might not significantly affect your overall returns. 2. The risks of relying on a single stock. Putting all your eggs in one basket by relying on a single stock for your passive income can expose you to various risks. Company-specific risks. If the company you invest in experiences a decline in its financial performance or faces legal or regulatory issues, it could reduce or suspend its dividend payments. This would directly impact your passive income. Sector risks. If the industry in which the company operates suffers from a downturn or increased competition, the company's stock price and dividend payments could be negatively impacted, reducing your investment returns and passive income. Market risks. A single stock may be more susceptible to broader market fluctuations than a diversified portfolio. If there's a stock market crash or a recession, the stock's value could decrease, and dividend payments may be at risk. 3. Balancing diversification and income generation. To achieve a diversified portfolio while still generating a substantial passive income from dividends, consider adopting a balanced approach that combines multiple investment strategies. This may include investing in dividend growth stocks, higher-yielding investments like REITs, high-dividend yield stocks, and alternative investment options like covered call ETFs. By spreading your investments across different asset classes and sectors, you can reduce risk and maintain a steady stream of passive income. So what are covered call ETFs exactly? Covered call ETFs are a type of investment fund that primarily invests in stocks and uses a covered call strategy to generate additional income. The fund manager writes, sells call options on the stocks held in the portfolio. When the options are sold, the fund receives a premium, which is typically distributed to investors as dividend income. The covered call strategy can provide investors with higher dividend yields than traditional dividend-paying stocks or ETFs. Advantages of covered call ETFs. High dividend yields. Covered call ETFs often provide higher dividend yields compared to other investment options due to the additional income generated from the option premiums. Diversification. Since ETFs invest in a broad range of stocks, investing in covered call ETFs can help you maintain a diversified portfolio while still generating high dividends. Lower volatility. The income generated from writing call options can help offset potential declines in the underlying stock's value, reducing the overall volatility of the fund. Professional management. Covered call ETFs are managed by professional fund managers who use their expertise to select stocks and write call options, potentially increasing your returns and reducing risks. What are some examples of covered call ETFs? QYLD. The Global X NASDAQ 100 Covered Call ETF, QYLD, is designed to track the performance of the CBOE NASDAQ 100 Buy Right Index. The ETF primarily invests in stocks from the NASDAQ 100 index and writes call options on the same stocks. QYLD has a relatively high dividend yield, making it an attractive choice for income-seeking investors. JEPI, the JP Morgan Equity Premium Income ETF (JEPI), seeks to generate income by investing in large-cap U.S. stocks and employing a covered call strategy. The fund aims to provide investors with a combination of capital appreciation and high dividend income, targeting an annualized yield that is significantly higher than that of the S&P 500 index. NUSI, the Nationwide Risk-Managed Income ETF (NUSI), is an actively managed ETF that seeks to provide investors with high monthly income while protecting against downside risk. The fund invests in a diversified portfolio of stocks and uses a combination of covered call and protected put strategies to generate income and manage risk. Covered call ETFs can offer investors an attractive solution for generating high dividends while maintaining a diversified portfolio. By combining the benefits of professional management, lower volatility, and high dividend yields, covered call ETFs can be an excellent choice for investors looking to live off their passive income. To sum it up, let's compare the investments required in the different approaches discussed earlier to achieve $4,000 a month in passive income. We will analyze dividend growth investments, higher yielding investments, high dividend yield stocks, and covered call ETFs to determine how much money you need to invest in each strategy to reach your monthly income goal. 1. Dividend growth investments. Dividend growth investments focus on companies that have a history of consistently increasing their dividend payments. Johnson & Johnson, for example, has a dividend yield of approximately 2.5% as of this writing, to generate $4,000 a month or $48,000 a year. From this investment, you would need to invest $48,000 / 0.025 equals $1,920,000. So you would need to invest $1.92 million in Johnson & Johnson stocks to achieve your passive income goal using this strategy. 2. Higher yielding investments. Higher yielding investments offer a higher dividend yield compared to dividend growth investments, which allows you to invest less capital to achieve the same level of passive income. Realty Income, for instance, has a dividend yield of about 4%. To generate $4,000 a month or $48,000 a year. From this investment, you would need to invest $48,000 / 0.04 equals $1,200,000. With this strategy, you would need to invest $1.2 million in Realty Income stocks to achieve your passive income goal. 3. High dividend yield stocks. High dividend yield stocks offer even higher dividend yields, which further reduces the amount of capital required to generate your target passive income. Altria, for example, has a dividend yield of around 7%. To generate $4,000 a month or $48,000 a year. From this investment, you would need to invest $48,000 / 0.07 equals $685,714. In this case, you would need to invest approximately $685,714 in Altria stocks to achieve your passive income goal. 4. Covered call ETFs. Covered call ETFs can offer an attractive balance between high dividend yields and diversification. The dividend yields for these ETFs can vary, but we will use an average yield of 6% for this example. To generate $4,000 a month or $48,000 a year. From this investment, you would need to invest $48,000 / 0.06 equals $800,000. With this strategy, you would need to invest $800,000 in covered call ETFs like QYLD, JEPI, or NUSI to achieve your passive income goal. The amount of capital required to generate $4,000 a month in passive income varies significantly depending on the investment approach you choose. High dividend yield stocks and covered call ETFs typically require less capital investment compared to dividend growth investments or higher yielding investments. However, it's important to consider the risks associated with each strategy and the importance of diversification when deciding which approach is best for your financial goals. In conclusion, living off dividends is a feasible goal for investors who are willing to carefully select the right investment strategy and manage their portfolios prudently. While it may not be possible to generate a significant passive income from dividends without investing millions of dollars, it is achievable with a smaller investment by focusing on high dividend yield stocks and covered call ETFs. Furthermore, reinvesting dividends can offer long-term growth potential and help you reach your financial goals more quickly. By understanding the various investment approaches and the importance of diversification, you can make informed decisions and work towards achieving financial independence through dividend investing. Thank you for watching the video. If you liked it, please subscribe to the Finance Bull for more money and investing tips. Until next time.